stance. This is what we call a bull stampede or a bullish stampede. So you kind of think about a stampede of bulls, right? They're all just running in one direction. That's what's going on right now. We've got this bullish stampede going on, which means you have minimal drawdowns and lots of updates. So it's just the market just kind of grinds higher and it just kind of keeps moving higher. And investors are going, I don't understand what's going on here. This market's just never going to go down again. But that's that bullish stampede. Then conversely, what will ultimately happen is at some point we'll get a bear stampede. And then this is where investors will go, I just don't understand why this market won't stop going down. And, we go through these from time to time. Nonetheless, to your point, we are very overbought here. And that's going to limit upside. Doesn't mean markets can't go up a little bit further from here. They certainly can. But again, just be aware that, we're pretty stretched. Same thing.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week for a weekly market recap featuring my good and vertical friend, Lance Roberts. Lance, that was vertical with a D. I'm going to assume, perhaps you and not everybody watching not everybody knows what that word means. It means truthful, like veritas. So anyways, you're a guy who's a straight shooter, doesn't mince words. I thought vertical was pretty appropriate for you this week.
See, I thought you meant vertical with a V because after getting ready for this conference this weekend, I've been working late. So it's surprising I'm vertical today.
Yeah, I think next week you're going to be my horizontal friend, Lance Roberts.
Correct. That will absolutely be the case. But yeah,
and speaking of which, as we're talking here on this video, and folks are watching it probably on Saturday morning, we are at your event in Houston.
That is correct. So yeah, very excited today to be talking to a fairly large group of people and just talking about the economy, the outlook. Greg Valliere today, who is a political commentator, talking about the presidential election cycle, what to expect from this election. So, and how it's going to affect the market. So yeah, very excited about it. It's going to be a very interesting day.
Okay. So on the day you and I are talking, Lance, we've had 5 consecutive all-time highs in the S&P. TBD if Friday is going to close at another all-time high or not. Real quick, just want to give a quick preview for something I'll talk about at the end of this discussion. So we're at your conference right now as folks are watching this. I have not only locked in the date for my conference, but now tickets are on sale for it at the early bird price. So I'm going to give everybody all that information at the end of this video. And also, just very happy to announce, as we talked about last week, that I had passed my securities exam. I am now able to officially start referring people to our endorsed financial advisors like your firm, Lance. And so thoughtfulmoney.com, folks, I'll give you all the details on that at the end of this video, but wanted to give a little advanced celebration here. It's so nice to have that up and running again. All right, Lance, so like I said, 5 consecutive all-time highs in the S&P here. Tell us what's going on. Maybe we want to pull up the S&P chart that we normally view each week. My key question for you is, are we entering into overbought territory here with these consecutive all-time highs, or are we still sort of staying in that band?
No. We are definitely not. Let me get to share screen here. Yeah, no, definitely not in that band anymore. We were in this band back in mid-December and early January, broke out of that decisively. And early January, we've been kind of ratcheting up ever since then. We're back on a MACD buy signal. And, so there's a couple of interesting things that are going on. So first of all, this breakout to new highs, and we consolidated for a very long period. And, from that consolidation process, you would expect that the market's going to move up or down and break out of that channel. And so we broke out to the upside. So that's good news. The bulls remain very intact. However, we are back to overbought conditions, but we're also on a MACD. If you look at the top part of this chart, we're back onto a MACD buy signal. So this buy signal, this little highlighted circle, is back intact. Now, just because we're on a buy signal doesn't necessarily mean that we're going to take off running to the races, higher. We're going to go up 10% from here or whatever. I mean, anything's certainly possible, but kind of like as is always the case, when these indicators are flipping back and forth at a fairly high level, price advances continue to be contained somewhat. So Again, if we look back, to June of last year is a good example of this. We were at a fairly high level on the MACD like we are now. So very similar type of setup. Triggered a sell signal. The market kind of flopped around for about a month or so. Didn't, kind of grinded higher, but ultimately really didn't go anywhere. Flipped back to a MACD buy signal in about mid-July. Flipped back to that buy signal, about the same level that we're at now. And the market rallied through the end of the month, and then that was it. And then we had that 10% correction. So it's not unusual for the market to be doing here what it's doing. Very similar to what we saw since November, December, halfway through January now, has been a very strong advance. This is what we call a bull stampede or a bullish stampede. So you kind of think about a stampede of bulls, right? They're all just running in one direction. That's what's going on right now. We've got this bullish stampede going on, which means you have minimal drawdowns and lots of updates. So just the market just kind of grinds higher, and it just kind of keeps moving higher. And investors are going, I don't understand what's going on here. This market's just never going to go down again. But that's that bullish stampede. Then conversely, what will ultimately happen is at some point we'll get a bear stampede. And then this is where investors will go, I just don't understand why this market won't stop going down. And, we go through these from time to time. Normally these stampedes last 15 to 20 trading days, but they do occasionally last longer. We've had two very long advances just since last year, March, April, May, June of July of last year, and now November, December, January of this year. These are very long kind of advances for these bullish stampedes. But consequently, you're eventually going to get this bearish stampede that investors are going to start talking about, oh, the bear market's back. This market's never stop going down anymore. It's all over. And this is just how market psychology works. And this is why it's really important not to get trapped up into these narratives about, markets, nothing's going to bring this market down. It's just going to go up forever. You're eventually going to get selling pressure because simply you get an imbalance of buyers and sellers. And at some point, all the people that will have wanted to buy stocks will have bought them. And those that have sold, they've been selling all the way, and they're basically out of stuff to sell for the most part. And then you get this reversion because now the buyers will want to start selling and the sellers will start buying again. So that's just how markets work over time. Understand the dynamics certainly helps a lot to kind of navigate the psychological side of this. But nonetheless, to your point, we are very overbought here. And that's going to limit upside. Doesn't mean markets can't go up a little bit further from here. They certainly can. But again, just be aware that, we're pretty stretched. Same thing holds true if we look at the volatility index versus the S&P 500. Let me change this to a line so it's a little bit easier to see. Daily volatility messes that up. So here, let's just look at this. So if you take a look at the volatility index, we're picking down. I mean, we're at basically about 13 on the VIX, very, very low levels. And normally when markets are screeching higher like they're doing now, and you have very low volatility, this is a point in time where, nobody's convinced the market's going to come down again. So why buy puts? That typically tends to be kind of an inflection point to where you start getting some type of correction in the markets. Again, doesn't mean the market's going to crash, doesn't mean anything like that. It just means you're going to get a pullback in the markets to give you a better opportunity to add some exposure to portfolios. And so again, just have to kind of navigate that for what it is and just understand this. Now, one last chart here, then I'll throw it back to you.
Hey, real quick before you you just left that chart.
Right.
But so that was a 2-year chart in volatility you had there?
Yeah, that was about 2 years. Put that back up.
I mean, I guess we're back up in the 13s here. We were down in the 12s not that long ago, but I just want to note here that volatility is more compressed or subdued than it has been in at least 2 years here, right?
Yeah, no, this is we're plumbing kind of all-time lows for volatility. I mean, normally we used to bottom around 15. That was a very low level of volatility. Now we're doing 12 to 13. So yeah, we've really ever since the October 2022 bottom, where we were talking about then. Of course, you'll remember back then, October of 22, everybody's like, it's a recession's here and the housing market's going to crash. We're de-dollarizing, rates are going to go to the moon. and everything was so negative. We said, hey, this is a really great setup for the markets, because you have such negative sentiment that's going to drive a bullish turn to the markets. And we wrote a couple articles about this and other things. Of course, everybody believed FANG stocks were dead at that point as well. Then, of course, since then, we've had this massive, rally. A lot of it's driven by the FANG stocks in particular. And that's just been compressing that volatility ever since. So we've just compressed volatility to basically nothing at this point. And, which is, again, like I said, that's just a really good, when you have that kind of compressed volatility, it's like a spring. Volatility wants to go higher. It's just a function of what triggers it.
All right, Lance. Well, look, I think one of the questions that's increasingly getting asked now is, is there potential for a melt up here, right? We've got this bullish stampede. We've got companies coming out of their buyback window. We've got good macro news. We'll talk in a moment about the 5 sigma beat on the GDP number for Q4. And tied to that is this narrative, which I know you've got something to say on because you just wrote a piece about it. Huge surprise.
Yeah.
Which is that there's all this money on the sidelines, right? All these trillions that have moved their way into money market funds, and now that there's a party going on in stocks and that the Fed might be cutting rates, all that cash is going to slosh into the stock market and start driving stocks higher. So what's your thought here on this sort of market melt up? I'm not saying crack up boom, because that's a different phenomenon, and there are other people beginning to talk about that too. But let's stick with the melt up potential here. What do you think?
Well, no, I mean, look, markets are, doing exactly what you would expect them to do. And again, we had spent 2 years going nowhere. So theoretically, we January 22 to January 24, the market's return was 0. So that's, we just spent last year getting back to even. So in a market melt up, this is where you're just, gyrating higher. Absolutely nothing, out there is able to stop the market. It certainly seems that way right now. But look, economic growth is good. We just saw a PCE come in today with personal spending at 0.7. Expectations were 0.4. Personal incomes were, in line with at 0.3. GDP growth at 3.3%. There's there's some things going on with GDP numbers, but again, like you said, GDP is fine. Unemployment's low. Unemployment rate is low. There's just, there's really nothing here to, concern the bulls, so to speak, in terms of the market. And we're not making 1% advances every day. The market's grinding higher, but we just spent a month and a half consolidating a range. And so technically the markets are behaving actually very normally. I mean, yeah, there's no volatility right now. Markets aren't jumping up and down. We're not having, 2% up days and 2% down days, that type of thing. But there's nothing here that really suggests you're having a big melt up of the market. Now, there's some stocks that we can certainly talk about. NVIDIA, AMD, some of the, the AI stocks, they have certainly gone parabolic here over the course of the last couple of weeks. In particular, NVIDIA, as an example, is up 20% this year. We added NVIDIA back, I think, in November of last year, and it's up 20% in 2 weeks. So that's the type of thing you don't like to see as an investor, because these very outsized gains are going to have to give up here a bit. Eli Lilly, which we've added to the portfolio, that's doing very well. AMD, since we bought AMD in late 23, it's up like 74%. So those type of stocks are just a little bit well ahead of themselves. So we're gonna, we took some profits in AMD on Thursday. And again, when that stock pulls back, we'll rebalance the portfolio, buy some shares back, because the thesis behind those stocks is still very strong. But the overall market, there's a lot of weakness. If we were looking at this market and saying, man, just everything is going up, it's not really the case. The market is going up because of a handful of stocks. We're right, and this is something that we're talking about today, right now. This is something we're talking about in my presentation today. Is we're back to the MAGA 7. Actually, it's the Magnificent 6 now.
So I was going to mention that. Yeah. So go on with that, because we've got one that's kind of beginning to fall out of that.
Yeah.
That camp, right?
But yeah, and it's really, when you really drill down into it, it's really 2 stocks. It's NVIDIA and Meta. or Facebook. So those are really the two driving the market. But again, they make up 35% of the market. And so if you take a look at the advances in the S&P versus the equal weight index, there's a big disparity again. A vast majority of the market is not going up with the market. Healthcare is lagging this year, underperforming, with the exception of Eli Lilly. Utilities, real estate, those stocks, a lot. You remember at the end of last year, we had that very strong advance, really kind of that broad advance. Small caps are doing great. Mid caps are doing awesome. They've all kind of given up the ghost this year. We're back to that very narrow advance, which, certainly provides some concern about that group of stocks. But as far as the market itself being very overbought, it's kind of an illusion of a very small handful of stocks. If you really want to understand what's going on with the market, look at the equal weight index. It's a much better indicator about what the market is doing and whether or not there's actual meltdown. Okay,
and so we referenced one of the companies of the Mag 7 starting to struggle. That's Tesla.
Right.
So Tesla had been a real bellwether for years, right? It was the unstoppable company, right? That's beginning to struggle. We're also beginning to see some surprises from some companies that are pretty good bellwethers for the economy. These are disappointing surprises, and their stocks are getting hammered for it. One I'm thinking of right here is Intel, right? They just disappointed yesterday. I think right now, when we're talking, the stock's down like 10%.
Right.
To your point, like, it doesn't seem like a broad-based rally here necessarily, and it seems like, in fact, some important companies that have done a lot of water carrying over past years are starting to stumble.
That's right. And again, this is, as an example, Intel is just, has, bad guidance. They really can't seem to get out of their way in a lot of cases. It's the same thing for Humana. Humana is down like 30% in 2 days this week on bad guidance about what's happening in the insurance carrier space. So, it's definitely a stock by stock basis. You can have a portfolio of stocks and do nothing right now because you don't own the right stocks. And you may look at your portfolio, man, the market's going up every day. My portfolio is not doing anything. Why? It's because you don't own all the right stocks. You've got to own those 7 stocks, unfortunately, to have that kind of, and there's other stocks. I shouldn't say it's just 7, but you can take a look at Broadcom. You can take a look at Salesforce, CRM. There's a variety of other companies in kind of that tech space. They're driving the market. Flipping over to healthcare, it's Eli Lilly. Just that stock just has been unstoppable. Take a look at kind of the defense sector. Raytheon had a bit of problems. They've got themselves kind of straightened out. That stock's been performing a lot better. There's just, and kind of going to each little sector, there's 1 or 2 stocks that are performing very, very well, but a big swath of them are not. And that's really the problem with the overall market.
All right. I realize we still have to get to your kind of dismantling of the narrative of cash on the sidelines that's going to potentially power melt up. Real quick before we get there, we are now beginning to enter earnings season, right? That's why we're getting some of these news events or conference calls that are either popping stocks or dropping them. What are earnings telling us right now? Because you wrote a piece earlier this week about the markets and where you said going forward, earnings are key to where this market's going to go. So what are we learning so far?
That earnings are actually kind of disappointing. So far, look, we haven't had that many companies report yet. Now, by the time that we do this show next week, we'll have a lot bigger sample of earnings in. And then by the following Friday, we'll have about 80% of the S&P 500 will have reported. So we're going to have a really good indicator about just how good this earnings season was. But so far, very early in the season, we're running about a negative 3.4% disappointment relative to what estimates were. So, stocks aren't, and those earnings have been cut. We wrote about the very drastic cut to Q4 earnings estimates right at the beginning of this year, and those estimates got cut by $8 over 2 months, wrapping up the year. So that bar was set really low, and we're still missing that bar on a lot of fronts. Guidance has also been weak on a lot of fronts. Now, again, we still haven't gotten to a lot of the bellwethers. We haven't heard from Apple, Microsoft, NVIDIA. Those companies are later. But so far, there's been a couple of companies that have come out and had done really great. They've had big pops. And there's been a lot of disappointment. Like I said, Humana is a good example of that. So that drags down other stocks and sectors like United Healthcare. So there's definitely knockoff effects.
Okay, and how important is it going to be in your estimation? As companies announce, they begin to get freed up to start doing buybacks again. How big of a factor do you think that's going to be this quarter?
Well, it's funny because I said that back in October. I wrote an article back in October. I said, October weakness will lead to an end of the year rally for 3 reasons. And the first reason was very negative sentiment, which we had. Second reason was that just kind of the end of the year, there's portfolio positioning, that type of thing that happens that tends to drive the markets. And it's basically have to rebalance portfolios. A lot of managers were well underweight. They were lagging performance, had to play catch up. The third reason was buybacks. And we were expecting $5 billion a day in buybacks at that point. And I got a bunch of blowback from people like, buybacks don't drive the market. And I'm like, okay, whatever. But you had a record amount of buybacks in November and December, which just sent this market racing through the roof. And then those kind of ended right towards the end of December. Went back into the blackout period. That's where the market's been struggling. That buyback window has started to open back up. So as companies announce earnings, they can start buying back shares. Even companies like Nokia just announced a $630 million buyback on their shares. That's a very small company now. It used to be huge. But that window's opening back up. And once we get through Friday after next, that window's going to be pretty much open and the buybacks will begin kind of in earnest again.
All right. We've ranted about buybacks so many times, but one element about it that just still sticks with me is the decision to do a stock buyback. In theory, is we, the management, have looked across the universe of opportunities for where we can invest our excess capital, and we have determined of the entire universe that our stock is so undervalued, it's the best purchase to be made right now. And what's so interesting and why that's just such a fallacy is because it always comes back to being, each CFO says, we've looked at the universe and I've just determined it's my stock that's the one that's undervalued, right? They could be buying Apple, they could be buying any other company, right? But for some reason, it's always their one particular stock. And we're going to put all our 600 and whatever million into that one stock. We're not going to diversify it across. So it's all just shenanigans, and it's all just that shell game to make your EPS look better. I mean, yes, there's some other reasons. If you're retiring, if you're buying it with debt, let's say, that's got a lower interest rate than the dividends that you're replacing, but those days are over because debt's so high now.
Right, but even those were done to the benefit of the insiders. The SEC did an investigation and found out that in every case, buybacks are done for the benefit of the insiders of the companies, because that's who sells back the stocks. And this is one of the big fallacies about buybacks that people always talk about. It's like, it's a return of capital to shareholders. Really? I mean, did you get a check in the mail when Apple bought back shares of Apple? No, you did. The only did somebody call you and say, hey, Adam, I want to buy your shares back? Nobody from Apple called you. I mean, as an individual, I can buy and sell shares of Apple every day on the market. The only people that benefit from the share buybacks are the insiders, who are the ones selling their shares, which are generally restricted, back to the company. And that's how they create these massive, this massive wealth of C-suite executives. And, but it's not a return of capital to shareholders. You got nothing from it. And people say, well, the stock price went up. Yeah, Apple did buybacks all during 2022 when the stock price was going down. So that doesn't hold water either. It's just a function. And look, there's been plenty of studies. It's a function to manipulate EPS in order to meet Wall Street estimates. The other 10% of the fudging comes from CFOs to beat EPS. So that's all this comes down to.
Right. And, to compensate many times richly your executive staff, right? Capital is going to shareholders. It's just going to a very few who are the inside top executives.
And actually the correct statement, you made the statement, the right statement, which is, we've looked around the whole universe of the world and our stock is the only thing we're spending money on. The reality of that, and you're right, that's an absolute fallacy. The reality, though, is that what companies are saying by doing buybacks is that I've looked all around the world and I cannot find a single thing better to do with my money that I can generate as much benefit for myself than buybacks right now. I mean, think about all the money I could have used. Apple could have bought a new technology company to, do something,
Right.
help them and to, go buy an AI company, go fund a big AI company. The problem with that is that if I buy a company, it may take years for that acquisition to inure,
To generate the return. Yeah.
Exactly. So, and that takes too long. I just do a buyback. I can get it right now. So, the problem is that these buybacks, and there was a reason why buybacks were illegal until 1990. But the problem with this is, and the average American, we take their polls, they're upset about the economy. I wrote an article about that earlier. You take a look at polls. I mean, average Americans upset about the economy. They're upset about the wealth gap. They're upset about all this. But buybacks are one of the big reasons that contribute to that, because if companies didn't have that option to do buybacks, they would have to spend that capital making an acquisition, building a plant, creating jobs, doing those type of things, which would actually inure to the benefit of a broader swath of Americans and make the economy much more profitable.
Mm-hmm. Well, I'm gonna still stick to my prediction that at some point in our lifetime, buybacks will likely be illegal again, and I will cheer that when it happens.
Well, there will probably never be made illegal because there's too many people on the political side that benefit from it. But there will be an end to buybacks. There will definitely be an end.
Yeah, and I
think
because
at some point every company will go private, so there won't be a market.
They've got themselves totally back. Yeah, I'll predict before then that there will be some tight, tough times for the country, and buybacks and the enrichment of the C-suite through them is going to come into the public's crosshairs, and it's going to become an election issue at some point in time, and some politician's going to use it as their way to get into office.
Well, and again, the problem right now is that before that can happen, there has to be this realization that's right now, buybacks are treated as gold because it's a return of capital shareholder. It absolutely is not, but that's the lie that's been perpetrated on the average American. And so they think buybacks are a good thing. And, they're giving me money back. No, they're not giving you a damn thing back.
Right. But just remember too, though, 93% of financial assets are owned by only 10% of households. So a lot of, that means that the other 90% are saying, like, I'm not benefiting at all from this.
This is a true statement. Yeah. So anyway, all right, let's not rant on that today.
All right. Well, okay. Before I forget though, let's get to your point though about, well, why might not we see a melt up here because of these trillions in cash on the sidelines, quote unquote, flooding into stocks?
So yeah, a couple of reasons. So first of all, there's this every time that we start having a kind of a melt up in the market or whatever. This has been one of the goes. This is not a new thing, by the way, of the average person saying, "Oh, it's the cash on the sidelines, and we're gonna have all this." But every time we get these big run ups and money market balances, particularly last year in particular, there's this idea that all this money is going to come rushing back into the markets, and that really never is the case. And there's a couple of reasons for that. So this is the increase in total money market funds going back to 2011. Obviously, you see this big jump during the pandemic shutdown, the bank crisis. Savings kind of went. This money market kind of went sideways for a while, and then just recently has taken off. Up again as we just had this big pile into this. However, in order for money to be on the sidelines, right, it's got to come in and to come into the market. Then it's got to be in somebody's investment coffers, right? So first of all, the first thing you have to remember is that there really cannot be cash on the sidelines. And the reason is that for every buyer of a stock, there has to be a seller of a stock. So think about it like a football team where I have 11, I can have 300 players sitting on my benches, but I can only have 11 players on the field. And if I want to swap out a player, I've got to take one out and put one in, right? I can't put 300 people on the field to win the game, right? So that's not the way it works. So for every buyer, there's a seller. So the only difference is that you could have $1 trillion of money come into the market today, and you'd have to have $1 trillion worth of selling on the other side so that $1 trillion could buy something. So there's always an equilibrium. Now, the reason that people think that money will cause the market to go up is that the market, as the market advances, they go, oh, all this money's coming into the markets, that's why market's going up. No, we just have an imbalance of buyers and sellers. And so right now, in order to buy something, sellers are going, yeah, I'll sell you my Apple or my Nvidia right now, but man, you're gonna have to pay up for it. And if you want to buy it, you're gonna have to buy it from me at this price. So buyers are having to step up to find that. So the only difference between the buying and the selling is where that, at what price that transaction takes place. So in theory, if we had a whole bunch of that money, that everybody woke up today and said, hey, I'm buying the stock market today, and everybody went and pulled all their savings out of the bank and threw it to their money market account and their brokerage account, and then went and bought stocks, yeah, it would push the stock price up today, because all of a sudden you had this rush of buyers and it brought the equilibrium of the transaction price higher. But as soon as that rush of money is over, prices are going to come back down. And because again, markets are going to find their balance, and it's always an equilibrium of the buying and the selling. But so let's talk about where all the cash is, right? So there's all this money sitting in money market accounts, but where is it in terms of the market? So if we take a look at the equity to money market asset ratio, it's come down a bit here since the peak of the market in 2022, but it's still at the highest level. In other words, there's a whole lot more equity ownership than there is cash on the books across the board. So, I mean, you're still at a level higher than we were at the peak of the market of the bubbles and the dot-com crisis, as well as 2008 financial crisis. So not a lot of cash sitting there from that perspective. Take a look at the American Association of Retail Investors. They're heavily allocated towards equities. They've got 65% of their money in equities. They've got another 30% or so in bonds. They've got very little cash sitting in their money market accounts. If you're invested in the market right now and you got a whole wad of cash in your portfolio, you're probably going, I'm not making any money. I need to get into the market. That's what retail investors have been doing since October 2022, is piling that money back into the market. So that's retail. If we take a look at it a little bit different way, if we take a look at the amount of money market cash we have, so this is the total amount of money market cash, the 7 trillion, as a function of the market capitalization, there's not that much money there relative to the market cap of the financial markets. So
that's interesting.
You know, it's a very low now. But interestingly, look at the bottom of the market in 2009. Look at the money market to capitalization ratio at that point, and look at it at the dot-com crisis. And then, 1984, we were kind of coming out of that whole double back-to-back scenario with recessions and all that. But you take a look at the dot-com bubble in 2008, those were points where there was a lot of cash relative to market capitalization, which helped fuel the bull market. So, right now with where the markets are, there's not a lot of support. Okay. But now let's talk about professionals. If you take a look at mutual funds around there, they have some of the lowest cash on record. So there's not, if you're looking for this massive amount of money coming into the market, it's not in retail markets. It's not in investment accounts. It's not in an area that's going to flow into the markets. Where is all that money?
Hey, and real quick, and you can answer this in your answer here. Is that a sign that the retail, and I guess maybe the institutional investor, is pretty fully invested? Yeah. Right.
That's exactly what it is.
Okay.
Most people that are invested in the markets don't have a lot of cash sitting on hand. And again, now there's another way to look at this. So this is from the government office that reports and tracks all the money market account balances. So this is prime money market, government tax exempt, prime institutional, government tax exempt retail, prime retail, which is that little yellow band. Prime retail is where your money is. That's the retail money market. That big blue chunk that's there, that kind of light blue, that's the massive amount of the money that's there. Those are institutional prime money market funds. Those accounts are generally minimum of $100,000 account balance. A lot of them are $1 million as a minimum account balance. This is where institutions and companies are holding their cash. That cash that's used for operating expenses, payroll, those type of issues where, you think about a company like Apple or Google or Meta or Berkshire Hathaway that has 130 billion in cash on hand. That's where that money is. That's the money that's used for stock buybacks and other stuff like that. But that's not money that's going to come flooding into the retail, kind of stock market positioning. So again, most of that is for corporations or high net worth individuals that is slated for other use, not buying, shares of a company in the market.
Okay. So, yeah, I mean, you're kind of dismantling this expectation that there's this, tsunami of cash that could just easily flood in here. I like your football team analogy. Maybe just a more simple way for folks to think about that, though, is I'm investor A, Lance is investor B. Lance has a stock I want to buy from him. So my cash is in bank A, and I take that cash and I give it to Lance to buy his stock. Lance then sells his stock, gives his stock to me, right? Because I've just given him cash, and he has to put that cash somewhere. So he puts it in bank B, right? So the same amount of cash has stayed in the banking system. It's not like it's gone and stayed in the market. All that exchanged hands was the stock at whatever price we transacted at. But the cash itself was in the banking system, and then it went right back into the banking system.
Exactly. And I just wanted to focus on this one last chart here. This is the 4-week change in share buybacks versus the S&P 500. I just want you to notice that ever since really 2015, really going back, you could say really in 2009, it started to grow. But you can just see how that volatility, how that range of transactions has just expanded really since the financial crisis. And that's where all that money's just been going into stock buybacks ever since then. And it's interesting, one of the things, this last point about money markets is that money markets, if you take a look at this chart goes back to 1974. So this is money market total assets in millions, back to 1974. What's interesting about this is that if you just kind of drew a linear trend, money markets have just been accumulating ever since 1974. There's never a period where you see this massive drawdown in money market accounts because it went somewhere else, it went to the markets or whatever. It's just been accumulating, and it just continues to accumulate. The more that we do, debt-driven finance and those type of things, you have this expansion of these money market account balances. Ironically, when those balances are drawing down the most is during the period you really don't want to be involved in the markets, which is during the dot-com crash, during the financial crisis. That's when money's getting liquidated and really, quote unquote, effectively destroyed during those financial crisis moments. And even during the pandemic, we saw money markets kind of flatline and then started taking off again. But this goes back to, who is it that's actually storing all this cash? And it's mostly companies. It's just as companies, have not a use for their cash, there's just getting piled up in money market accounts.
So, Lance, I would assume that the correlation between the accumulation of money market funds over time and the money supply is probably pretty tight. Is it? Have you ever mapped the two?
I haven't mapped the two, but just kind of eyeballing it, I would suggest I would probably imagine that the correlation would be decently high. I'll do the work. I'll check it out.
Okay. Yeah, and it just might be it's in some way sort of a soft proxy for money supply.
Yeah.
Okay. Well, look, super interesting. So much to get through. Let's charge ahead and see if we can get through at least most of this list before I got to split to the airport to go meet up with you there in Houston.
Yep.
Okay, so we've got a Fed meeting coming up this week, right? So Jerome Powell surprised everybody at the last one. We'll see what happens this time around. I'm going to ask you in a second, what, if anything, are you expecting to hear at this one? I just want to give the context that former Fed chair, Janet Yellen, was just interviewed recently, and I don't know if she's foaming the soft landing runway or whatever, but she's trying to talk up, the positive sentiment that seems to be continuing to build here with this bullish stampede. She said that she thinks 2024 is going to be, quote, a very good economic year. She cites consumers and households feeling confident enough about their own personal financial situation and about the economic outlook to be spending in a way that's creating jobs, creating growth, and is providing them with the income to go on doing that. And I don't see a reason why that can't continue. So I might take some issue with some things she said there, but anyway, she's out there saying, look, happy days are here again. Any comments on Yellen's comments there? And then what are you expecting, if anything, to hear from the Fed this week?
Well, so first of all, Janet Yellen's never been right about anything, so take that with a grain of salt. You know, she's the one that said we'd never see a crisis in our lifetime again. Then we have the COVID shutdown. So you just take it for what it's worth. We've written a couple of articles recently about what's going on with the Fed, and we've made some comments in our daily commentary as well. It was a very interesting change. On December the 1st, Jerome Powell says, "Hey, no reason to cut rates right now."
We're not even thinking about talking about it. Yeah.
Yeah, exactly. Just paraphrasing. And then December 13th, it's like, oh yeah, we're trying to figure out the best way to start cutting rates. And it's like this immediate change. And I've talked about this a little bit before, but this reminds me very much of 2018 and 2019, where the Fed said, hey, we're nowhere near the neutral rate. Then a month later, they're at the neutral rate and the markets are down 20%. And then by June, they're cutting rates and we're doing reverse repo and trying to stave off some type of financial event in the markets. And so this change in attitude certainly is suspicious from the standpoint that there may be some stress financially with one of their member banks, or maybe a few of them, that there's a problem that's potentially brewing in the overall economy. And, don't know that, and we won't know that for a while, but that change is certainly not something, I mean, they were, steadfast, hey, we're here to fight inflation. Inflation's not at our target yet. We're not even thinking about cutting rates, and then all of a sudden we are. That suggests there's some other risk that's going on that's out there that we may not be aware of yet. And so from Powell's standpoint, you have to be somewhat concerned about this FOMO market we've got going on, because that is increasing consumer confidence. If you look at the last consumer confidence report, it was a massive jump in consumer confidence. And consumer confidence is now the highest it's been in 2.5 years. That's not what you want in an economy you're trying to slow down to beat inflation. Personal spending just came in on Friday, up 0.7%. Big jump in personal spending. That's not what you want to see if you're trying to combat inflation. Now, PCE came in line at 0.2, but that spending, that consumption, that confidence is not what you want. I mean, this is the whole reason Ben Bernanke did quantitative easing in 2010. He says the reason we're doing quantitative easing is to lift asset prices, to boost consumer confidence, to strengthen the economy. Well, you've got consumer confidence running off the rails right now. People's expectations of retirement income is at an all-time high. People's expectation of inflation is dropping. People's expectation of higher stock prices in the year is very near a record. So, everybody's getting very, very bullish about the economy and the markets, and everything is great. That's increasing consumer confidence. That's inflationary. That is going to provide some inflationary impulse into the economy, or at least, if not inflationary impulse, it's going to make a contraction of inflation much harder to obtain. So instead of inflation being at 3% going to 2%, it may hang out at 2.5% or 2.8% for a while, because of just that consumer confidence. Now, the big question, of course, is how long can the consumer hang in there, considering they're borrowing money as fast as they can, just to kind of sustain their lifestyle. But, we'll see how this plays out. But, it would not surprise me at the Fed meeting to see Powell try to walk back a little bit of this exuberance, try to push out, the market's expecting 5 to 7 rate cuts this year. Can't imagine Jerome Powell coming out and confirming that. I would expect him to say, we're thinking about cutting rates, but it might not be till the last half of this year or something, just to try to pull some of the exuberance out of the market. That wouldn't surprise me. I'm not saying he will. It just wouldn't surprise me if he did.
Yeah. It's so interesting about those confidence numbers too, just because, and this is more anecdotal than everything else, but from what I hear from the average person, is not this sense of like, oh, best year ever, right? Like, oh, all of a sudden I'm not worried anymore about the future. And I'm not worried about the cost of living. I'm not worried about these record high housing prices. And even this job market that we're told is so amazing. I hear lots and lots of stories of qualified people saying like, who are between jobs saying like, I'm knocking a gazillion of doors and I'm not hearing much back. I mean, there does seem to be a real disconnect between the headlines and some of the data that's being touted and the general vibe, at least that I hear. And I realize that that's anecdotal, but obviously you don't have to scratch much at all to go on the internet and poke around, do a couple of Google searches and see lots and lots of articles about the plight of the average consumer. So it is interesting to see that disconnect.
It is.
All right. So I want to put up a chart here. This is a chart on interest on the national debt. And you can see here that it's just gone, completely exponential, almost vertical, as interest rates have cranked up here with the Fed rate hike campaign. And I want to talk with you about the concept of fiscal dominance, Lance.
Right.
But just looking at this chart, there's lots of things that are exponential, right? We can find all sorts of exponential trends in the economy and whatnot, but this has to have a limit on it, right? Because this is money that has to be spent annually, and the U.S. government annual budget is finite. I mean, yeah, we can goose it up with deficit spending and whatnot, but not to infinity forever. I guess if we want to just kill the currency overnight, sure.
No, no. You got two different things going on here. So first of all, you just said that, this can't go indefinitely higher because of the budget. We don't have a budget. We haven't had a budget since 2008. We run continuing resolutions, which means that every year a continuing resolution says, okay, you had $1 trillion to spend last year. This year you have $1 trillion plus 8%. So everything is reduced by 8%, not including any additional spending they tack on. So if interest rates remain exactly where they are and don't move, right, interest rates will go up or down, that interest service expense is going to keep going up in that parabolic line because we keep spending 8% more than we did last year just at the bare run. That doesn't include any additional stuff they throw on there, like 150 billion for Ukraine or whatever it is, right? So yeah, it can just keep going up forever because Janet Yellen can just turn on the printing press and just print more dollars to pay it. Well, now, I'm not saying there's not a bad economic outcome from that, but
right. But when it overwhelms tax receipts and there's all sorts of other mandatory spending that has to go on, the only thing you can do basically is borrow that, right? And then that just destroys the currency. So if we're worried about inflation and it's getting to the point where consumers are getting really angry about it.
Yeah, but hold on a second. How does borrowing money destroy the currency? Because the dollar's been going up.
Oh, I'm saying if the treasury is borrowing it from the Fed, right? If we get to the point where basically the Fed has to print the money to let the treasury then borrow to pay this stuff.
Hold on a second. The Fed doesn't print money. The treasury prints money. The treasury is the printing press. The Fed just credits the banks.
Okay. So it's the enabler, right? So basically, if foreigners aren't buying, if we go to the point where we're just letting this thing go hog wild, right? Presumably, many other buyers are going to say, "Look, I don't want to get your, I don't want to buy your treasury bonds anymore. You guys are fast becoming a banana republic." The only buyer out there is the Fed. But my point is this is growing so much faster than receipts. Right. Yeah. And so, it basically overwhelms everything else that we're doing. And we either have to make a decision to say, look, we've got to do something to get this under control, or we're going to go full banana republic.
Well, see, there's a lot of fallacy though in that. Because again, now you've got to introduce the concept of reserve currency status. You've got to do all this other stuff because again, look, I'm not arguing that printing money and debt is a good thing. Don't get me wrong on this, but we've got to be careful with the statements that we make because they have consequences. So, if right now we're printing a lot of debt, right? It took $2.50 of debt just to generate $1 worth of growth last year. I mean, that's just where we are.
Right.
If you look at it longer term, we're spending closer to $5 of debt to create $1 worth of growth. That's not a long-term benefit. That's why we don't have economic growth. You know, if you take a look at economic prosperity and those type of things, the reason that we don't have that, and the reason, you know, back in the 90s, we used to say 2% economic growth was pre-recession. That was a recession warning. If you're at 2% economic growth, you got to be careful. You're about to be in a recession.
Right. Now we're like, good job.
Yeah, we're just like, man, if we can just get 2% growth, we're doing awesome, right? That's terrible. And that's a function of all this debt that we've got going. But, you know, yes, right now, there's no limit to how much money we can print. There's really not a limit to the debt that we can produce, because right now there's nowhere else for anybody else to store currency. You're not going to store it in Russia, China, Brazil, Venezuela. Your only place to store reserve currencies, which is also a big part of that money market balance, is foreign deposits. So, you know, there's the government right now has a tremendous amount of runway because there's no alternative. I'm not saying that there won't be, and it's not going to be Bitcoin. But
right.
you know,
You're arguing the Brent Johnson dollar milkshake, like love it or hate it. It's
just the fact
the system. Yeah.
It's just the fact of what it is. And unfortunately, right, this keeps our government being fiscally responsible. And I completely support your point that you're making. Don't think I'm arguing with you, because I'm not. It's just important to understand that, you know, when you say things like, you know, it's going to destroy our currency, immediately I start getting emails from people going, if the currency is going to zero, then why am I invested in stocks, right? It's just, you know, we're talking about something that's take decades and probably will be dead before this occurs. I mean, look at Japan, you know, as a function of that. You know,
yeah. Although let's tug on that, because I don't necessarily know the answer here, and I understand the risk that you're talking about. But at this exponential, I mean, this getting now sort of near vertical, let's just assume that we just said we don't care, right?
But we've already said we don't care.
I know, but
every continuing resolution is a we don't care.
Right, but really we don't care, right? That like, whatever, you know what? So what? This thing just goes way higher than, you know, the revenues we take in every year, and we'll borrow 10 trillion in a little bit, and then we'll borrow 100 trillion, right? Whatever, right? You know, that will accelerate the decline of purchasing power in the US dollar, as we as Americans within America will experience it. Right?
Absolutely.
Yeah. So
your quality of life will get worse.
Right. And it'll get worse faster if we continue growing at an exponential rate, because exponentials speed up as they go on. Right.
That's correct.
Yeah. So
no argument there.
Okay. Yeah. And just to be clear, to your point, no one's saying it's going to go into the dumpster of history tomorrow. But we're at a concerning point here, right? Where this is, you know, it's I don't have the chart up anymore, but I mean, it's.
Well, no, it's a true point. But like I said, you know, we're at 120%. I don't know. I haven't looked at the latest number because it's moved so fast today. But you know, we're like 120% of debt to GDP. Japan's at 230, right? And take a look at what's going on with the Nikkei stock market. You know, it's going. Talk about something going vertical. That's the Nikkei. So you know, it's just, you know, these. You know, this can last. And this is my point, right? Again,
I don't disagree with this point you're about to make, just to be clear.
Yeah, just, you know, I'm not disagreeing with you about the evils of just being fiscally, you know, irresponsible, which our government is doing. It's just, it can last so much longer than you can possibly imagine. And again, you know, I'll be dead probably before this becomes a real problem. Unfortunately, my kids' I really don't envy the future for my kids. They're going to have a challenge. I think their children are going to really have a challenge.
Yeah, I agree. My hope is that the challenge gets addressed, just because I think it may just have to be in our kids' lives, and then maybe our grandkids. We can hope that they're you know, whatever follows, saner thinking will prevail, and they'll be growing up in that better world. But I don't know. Time will tell.
I mean, consider we're about to have civil war break out on the Texas border. I mean,
hey, you're getting to my rant. Hold on to that for a second.
Okay.
Yeah, don't
jump there. Okay.
Yeah, don't get the punchline out too early. Okay. But again, I want to push back just for debate sense on this, which is, yeah, in terms of like the US dollar potentially losing its reserve currency status and all that stuff. Yeah, that's probably after we're dead, right? But you and I could have had this discussion about the profligacy of the spending profligacy of our government and our concerns about purchasing power and all that stuff 4 years ago, before anyone had ever heard of COVID, right? And when you look at the inflection that chart took, right, in my mind, that just speeds up the timer here. And you look at just the trauma that household purchasing power has taken in the past 3 years, right? Like, if we continue going at the rate at which we're currently going at right now, or faster, which exponential systems suggest will happen, I can see some real problems happening in our lifetimes around this. And again, it's not from a Mad Max standpoint or whatnot, or collapse of the empire, but it's just like, this is the other rant I was going to have with you. Maybe I'll pull this up here. Home heating costs have gone bananas this year. Right. I mean, there's lots of other costs that have gone up. We railed in the past about like insurance costs that are going up across a lot of homes right now. But in addition to all the other cost of livings at the grocery store, at medical care, at the pump, education, all that type of stuff, all of a sudden, just essentials for living, like staying warm in the wintertime, have gotten a lot more expensive. And I just saw an article the other day that said heating your home in the winter has now become a luxury for many people. And I'll tell you, and I hate to share this, it's probably going to blow some people's minds, but I just got a warning 2 days ago from PG&E, which is the electrical and gas company out here in California,
the lights on the fires.
that my home heating bill is in danger of passing $1,000 this month, right? Yeah. And I'm just like, I mean, I'm blown away from that. We certainly haven't done anything differently that we normally do. I'm just thinking, I don't know how many families could have their home heating bill, go from like $300 a month to $1,000 a month this quickly, right? So like, I do worry, because we're seeing such an increase in the cost of living on the essentials right now, that if we continue growing at this pace, like there's a good chunk of America that's going to have to start tapping out and just say, I can't do it.
Yeah. No, I mean, it's problematic. I mean, we're seeing it. Like, it's interesting because, we just had sub 20, degrees here, and I love cold weather, right? So like, we don't even turn our heater on in our house. So
yeah, but cold weather for you is like seeing a purple elephant. It's a rare thing that you hardly.
Yeah, no, it gets hot, that's for sure. But yeah, I mean, heating and cooling both, and that was my point. Heating and cooling both is getting expensive depending on where you live, right? So you live up north, you worry about the heating costs because it never gets that hot during the summer. In the south, right, the heating in the winter is not that big of a deal. It's the summer cooling that becomes very problematic.
Right. And sorry to interrupt, but your point is that like, these aren't luxuries. These are existential needs, right? You live in Minnesota, you die in the winter if your house isn't warm enough. You live in Texas, you die if you can't cool down when it's like 112 outside.
Yeah, no, absolutely. I mean, how many people, or how many articles do you read every year where somebody, burned their house down because they started a fire inside their house to stay warm? Yeah. Right. So, it's just that kind of stuff. But yeah, no, look, this is what I was saying earlier about, when you talk about money market funds, you talk about, these type of things, you also have to understand that money market balances, by and large, as just a point of what we're talking about, is held by a very small percentage of people, right? The vast majority of people have no savings. And so if you already have no savings, and then your cost of heating goes up dramatically, and the cost of food goes up dramatically, and the cost of these other things go up, it's a fight. And look, I see, when I'm like on social media, on Twitter and stuff, I get, I just get inundated with people's comments about, well, the good example of this, right? As I published this article about money market account balances, and I made this statement in the article. Let me hold on a second. Let me just read this statement to you, because it sparked a whole big fight in the
Wait, you said something that sparked a fight? I don't believe that, Lance.
So Adam, this is actually a point that I made earlier this week. I wrote an article. Newsmax asked me to write an article for them about these all-time highs in the markets, and really to the point of what we're talking about, right? This all goes back to sentiment. And, if you're having trouble heating your home and you're having trouble, putting food on the table, your sentiment's not great. As we were talking about before, the sentiment issue is very interesting because again, we are to your point you made is that while we're seeing sentiment increase, and this is a composite index of consumer sentiment. So the black line is the consumer confidence. The blue line is consumer expectations. They have improved, right? But they're well off their highs. And so even though we're seeing some improvement, that improvement is really kind of on the upper end of income earners that are the market's going up, their stock balances are going up, their 401k plans going up. And when you talk about 401k plans, that's 25% of the population. Big chunk of people are not in 401k plans, so they're not getting that benefit. But this is, and so I made this statement. I said, so when you're looking at this as consumer confidence improves, I said this was the quote that I put out that I got a ton of lashback on Twitter because I said, given that higher rates remain and consumers have drained most of their savings, there is likely only a limited impact on further improvements in confidence. While stocks are currently registering all-time highs, much of that gain is based on the assumption the Federal Reserve will cut rates and reintroduce monetary liquidity. So the comment was, that is a super elitist statement. Only people in the financial markets, get the benefit from those Fed policies. That's actually a true statement that they made, right? Because 80% of Americans don't participate in what's happening. And so when you talk about things like increasing heating costs, increasing cooling costs, that's the real world of what's going on. And there's a massive gap right now between people's ability to make ends meet and their ability to invest in the stock market, as an example. That just doesn't exist for a lot of people.
I don't know what else I can say except just sort of amen, brother. I think you've really put your finger on it there. And I know we rant about this an awful lot in terms of the massive disparity between what the top households enjoy and all the pain that dribbles down to the bottom. What do you want to say? 80%, 90%?
Right. Yeah,
right?
exactly.
Well, it's going to be super interesting as how this manifests throughout the rest of the year. Especially given that it's election year and how much of this bubbles up, onto the radar of the two candidates running for president at the end. It's interesting because things like immigration right now are at the top for a lot, and we're going to talk a little bit about that in a moment. But these sort of base needs, I think, are going to be a higher. This is going to be one of those, it's the economy stupid elections, I think, especially as we get closer to November. Hey, real quick, because it's related to that quote you just talked about, I want to get back to that point of fiscal dominance.
Right.
So I'm going to read this definition here of fiscal dominance, then we can talk about it a bit. Fiscal dominance occurs when a national debt has reached levels such that a nation is unable to pay it down with taxes and requires monetary policy support in order to stay solvent. In such a situation, it is difficult to control inflation because raising interest rates can make it impossible for the government to pay its debt. So there's a number of analysts that I interview that are beginning to say, hey, we're now in the era of fiscal dominance. And these are folks like Lynn Alden, Luke Groman, just to name a few. You look at that interest rate spike in that chart I just showed earlier, and you're like, yeah, we're in the era where it's really getting hard for the government to pay what it needs to pay with the incomes that with the national income that comes in, and it's having to resort to ever greater deficit spending and borrowing, and that's the fiscal side of things here, right? So,
and then that's also to your point earlier about the Fed monetizing debt. That's why going forward, the Fed's going to have to monetize 30 to 40% of the debt issuance because interest rates can't go up, right? You can't have increasing deficits being generated by interest rates. So they're going to have to suppress interest rates in order to keep issuing the debt. So to your point earlier, the Fed's going to have to monetize a lot of that debt issuance to keep rates down at a level that's maintainable.
Right. So the problem with this is there are all the issues that are going to come from that. But as the fiscal side is being more and more relied on, two things happen. One is, that's money that gets out eventually into the economy and creates inflation. right?
Right.
And then secondarily, what this is saying is the Fed kind of has to start beginning to give up its inflation mandate, because it's like, I'm just trying to hold the system together at this point, right? So to your earlier comment there about, Powell might be walking down expectations of, hey, maybe I'm not going to cut as much and whatnot. Like in an era of fiscal dominance, it gets harder and harder for the Fed to tame inflation. And
Right.
Fed's kind of almost taken a premature victory lap here, that like inflation's totally done and the markets are partying hard, based on that. But that might be one of the surprises coming to the markets and in the general economy going forward here, is if we are indeed in this era of fiscal dominance, the Fed really may not be able to keep that horse, either get the horse back in the barn or keep it in that barn.
Right. Well, this is why QT is scheduled to end probably in March, if not May. And QE will be back by third quarter of the year, because again, you've got to get interest rates down. You've got to monetize the debt. You've got to reintroduce liquidity back into the marketplace. So, that's why there's the Fed is making this about face, is because the risk is there. This drain of liquidity from what they were doing with hiking rates, rising deficit interest, all that. That's all a drain on economic activity. So if you're going to try to sustain this, particularly going into an election, you're going to have to start reversing that policy, which is what's going on.
So just to put you on the spot, if you had to take the over or the under on current inflation expectations for the next year or two, what would you be taking?
I've actually been talking about this a little bit. Look, we're not going to go back to 9% inflation. Okay, that's not going to happen unless we start issuing checks again and shutting down the economy. So right now we still have an abundance of inventory that has to be worked off. So that's deflationary. But it wouldn't surprise me. Now remember though, we measure inflation on a year-over-year basis. So it wouldn't surprise me at all to see inflation tick up to 3.5%, maybe even closer to 4% just on a year-over-year basis. That wouldn't be surprising. If that occurs, we'll see what happens. But if you have stronger economic activity, and we kind of keep on this pulse of activity we've had going on, and again, because of all this money coming into the economy from the CHIPS Act and the Inflation Reduction Act and all that, which was not an Inflation Reduction Act, it was an Inflation Builder Act. So with all that money coming into the system, it wouldn't surprise me to see inflation tick up a little bit before it goes lower. So again, I think we're potentially about to get into that time frame where the year-over-year comparisons are, when you have a big drop in inflation, that if we come in with a 0.3, 0.4, we see inflation tick up a little bit, and that so you see inflation kind of level off and stabilize where it is, and then once we potentially get out in 25 or 26, we see that start to tailor down towards 2%, because that's just going to be a function of economic growth ultimately. So the more debt you have, the lower economic activity you have ultimately long term. So as we go from rather strong economic growth in the third and fourth quarter of this past year, that's going to start to tailor off as we get to 2025, which as that economic growth slows, that money comes out of the system, inflation will come down with that. But again, it may be longer to get there than people think.
Okay. All right. Let's see here. So kind of related, interest rates and bonds. So every week I always get asked the question, hey, what's Lance's latest on bonds, right? So I made the mistake last week of getting so wrapped up in our rant that I didn't ask you your trades. So I'm going to do that in a minute. But if you can just give us the latest on how you and your partner, Michael Leibowitz there, are looking at bonds right now, where you think interest rates are headed this year, what impact you think that's going to have on bonds, and then give a specific update on the TLT trade, because I get asked about that almost as much as I'm sure you do.
Yeah,
let's do that.
So yeah, no, interest rates are again, look, just like I said, the Fed, the government have to get interest rates down. That's just bottom line. Interest rates are too high for the consumer. It's too high for the economy. It's too high for the debt. So interest rates have to come down. We've got too much debt in the system to maintain these levels of interest rates. The deflationary pressure from the debt is going to drag economic growth lower. That will drag inflation lower ultimately, and interest rates will track inflation over time. So, we talked about in November, or actually in December, that we had taken a little bit of that, our bond trade off the table, just took a little bit of profit because we had that big drop in yields that really got to a very overbought level for bonds. So bonds got very overbought short term. So we've been going through that corrective process, a very healthy one now for the fixed income market. Bond prices have come back down. They're sitting right on their moving average. They started to bottom here lately. We're getting oversold. We're still in a MACD sell signal for bonds. That's about to turn positive. That signal is improving back towards a buy signal. So I would suspect that within the next, probably 3 weeks, maybe 4, that we're going to get a buy signal on bonds again. So we're getting pretty close, and we've had enough time to work through this overbought condition on bonds to be in a good setup position now for the next leg higher in bond prices.
Okay, so you guys are basically preparing for an entry point here. And will TLT still be your main vehicle for making that trade, or will you be buying individual bonds like you had switched to earlier?
Well, yeah, we switched from TLT to individual bonds mid last year, second quarter of last year. And then in our simple visor equity model, we use EDV. We switched from TLT to EDV to extend the duration. So that's where we'll be adding to.
All right. Hey, real quick, can you just give like the 60 seconds on simple visor? Because I've had a number of people ask about it, in particular, people who live outside the US,
right,
to say, hey, is this something that I can subscribe to and just use it to inform, my trading or my investing decision making? Can you just remind folks that aren't familiar with what simple visor is, what that service does?
And actually, we're going through a whole big upgrade right now. We're hoping to roll it out in the next month or so. But we're completely revamping the whole site, bringing in a whole bunch of new tools. So I'm really excited about that. I think it's going to be great. And we just launched a brand new portfolio this week on that platform. So, but Simple Visor is basically a do-it-yourself type of investment research platform. So as you want to research stocks, look at the markets, build and track your own portfolios, you can do that. We publish, there's a variety of information on here talking about, we look at the internals of the market, what's performing, major markets, analyzing those, ETFs and sectors, what's working, what's not working, sentiment. We run multiple sentiment indicators that kind of tell you where we are within the market cycle, what stocks are working, what stocks aren't working. Of course, we post all of our insights from our daily market updates to our trade alerts. We post those. Those actually get emailed to you and texted to you as well. Tons of research on, we talk about, relative versus absolute returns in the markets. All of those tools are available on the site as well. We have trading, we have screeners, just a variety of stuff. And of course, we also post our portfolios. So again, you can research your own, if you want to research a stock, do the chart, we share the charts with you every week. But we also post the portfolio models that we run for our clients. And like I said, we just launched 2 days ago, actually just launched a dividend model that is 70% dividend yielding equities, 30% growth equities. So it's a bit of a growth component to give you some S&P type returns with double the yield of the S&P 500. So we're kind of working through this model right now. But, again, so these are all there for you. And yes, if you live out of the country, you can certainly use this. When you put in your credit card information, just use any state in the United States. So pick Texas, and it'll work with Stripe, which is the credit card processing company.
Okay. And is sort of the shorthand for folks to understand is like, hey, if I want to do my own investing, but I want to kind of look over the shoulder of Lance and Mike and the team there at RIA, this is the way to do it?
Yeah, absolutely. So again, we basically, everything we do for our clients, we post on this. We post our trades every day as soon as we make them. So you kind of get, you don't have to do what we do. I mean, it's just what we do for our clients, and you can either follow along or not. It's right. There's all the tools are there to do all your own research. So you can build your own portfolios, track your own portfolios, do whatever. And then in about another month, we're going to launch all these portfolios plus about 6 other portfolios that you'll be able to just invest directly into and have them managed for you.
Okay. And if folks want to learn more about this, is it simplevisor.com or do they go to ria.com and then find it?
Simplevisor.com.
Okay, great.
Yep.
All right. Okay, so trades. Do the trades for the past 2 weeks if you can, because I forgot to ask you last week.
No worries. So the big bunch of trading this week was the launch of the of the new dividend equity model. So that was a big chunk of the trading that we did this week. We actually didn't do any. You didn't miss anything from the previous week because we didn't do any trades. We did do a few trades this week in particular. The first thing we did is like we swapped out. We added back to Apple. We had trimmed off Apple last year, and then the stock sold off a good bit, turned back up. So we added back into our position in Apple. And we also added a position of MGK, which is the mega growth ETF, into the ETF model. Because again, we have S&P based performance in the ETFs that we run in the ETF model, but they're underweight that big Mag 7. So we had to add a little bit of exposure to the Mag 7 to get a little bit more relative market performance. So that we started working on that. We also added a little bit this week to UNH, which got drugged down with Humana earnings.
United Healthcare, just for those who don't know the ticker.
So yeah, on United Healthcare, we added a little bit to that position because it just got drugged down with the Humana earnings, and is actually at a very good kind of buy point. So we added a little bit to that in our portfolio. We took a little bit of profit out of AMD because again, it's just gone straight up. And we also added to our position in Comcast Communications following their earnings. They had really good earnings report. So we added to our existing position there. So it's been mostly just kind of, we're still underweight equity a little bit. We're running about 54% equity out of 60% because it's a 60-40 model. So we're still underweight equity. We're still a little cash. So we're kind of wanting the market to pull back for us so we can put the rest of that capital to work. But we just been kind of nipping and tucking around the edges with our portfolio. Our portfolio is tracking the market pretty closely, even though we're underweight cash, which means we kind of got the right holdings, and now we're just kind of rebalancing weightings a little bit.
Okay. Help me just understand the Apple trade a little bit more. Was that more just a momentum trade, or were there other reasons to get back into it?
Technically, it had a nice correction, got overbought, held support, turned back up. And it's in the Mag 7. Look, look, I'm not a fan of Apple, right? I'm with the 75% of the population has a real phone called an Android. So when y'all decide when y'all get like waterproof technology for the Apple phone, Android had it like 3 years before you, right? So, shatterproof lenses, we had that like 5 years ago. So, y'all are you Apple people slowly catching up with our Android people. But, look, they're having all kinds of trouble they haven't grown revenues in 5 years, right? So, in a fundamental play, no, I'm not buying Apple for fundamentals. I'm buying Apple because I need performance in my portfolio. And today, I just did this analysis, for our presentation, at the conference this weekend. The top 10 stocks now make up 35% of the S&P 500. So for every dollar that goes into 334 different indexed ETFs and mutual funds, 35 cents of that goes into Apple and Eli Lilly, which we own, and Berkshire Hathaway, which we own, and Google, which we own. And you see, and that's why we own those stocks. We're not huge fans of those companies fundamentally, but fundamentals, we're in a market right now where fundamentals don't matter. You can be a fundamental investor all day long, and it doesn't matter. In fact, I made let me see if I can find this tweet here real quick, because I tweeted this out, I think on Thursday, if I'm not mistaken. But there was a very interesting graph about value. Oh, yeah, here it is. So this is a graph. So this is 1 year return on equity exposure by manager style going through December, and is active manager holdings versus the benchmark. And just what jumps out at you is that value on the far right-hand side is the worst performer. Growth, which is your growth stocks, Apple, Microsoft, Google, the largest performer. I said, the market reminds me of my dogs when I take them on the walk. They are well-behaved and doing what they're supposed to. In other words, looking at fundamentals. And then a squirrel runs across the path, growth stocks, and all hell breaks loose. And, that's exactly what's going on in the market. And so, there's this argument that, I'm just a fundamental investor. Great. You can be a fundamental investor and you're vastly underperforming the market, because that's the market we have right now. So we have to own these stocks in order to make money for our clients, but we do that with a very short leash.
Yeah, and it's not lost on me here that this is also the only sector, growth is the only sector there where the active managers had a worse track record than just buying the basket and letting it ride, right? So it's this just kind of this mindless, juggernaut right now, and you might not like it, you might not think it'll last forever, but you do not want to stand in front of it right now.
But it's a very interesting thing. I don't know. I really cannot fathom. I've thought about this a lot. What changes it, right? Because as long as people keep piling into ETFs, you proliferate the problem. So the only way to get a bifurcation is all of a sudden people have to start selling their ETFs.
You need net capital outflows. Yeah.
Yeah. And I don't know what causes that outside of, the next major credit crisis, which will happen. I mean, look, it's going to happen, right? We'll have a 73, 74 bear market again. We're going to have an 87 crash. We'll have a dot-com crash. We'll have a financial crisis of some sort. I mean, it'll happen, but we know we're in a secular bull market, and those tend to last between 17 and 20 years. We're, basically 13 years into this one. So we got a ways to go yet.
All right. Okay, I got to wrap things up here, given where we are time-wise. I was going to do two rants. One was going to be around housing, and I'll just note here that there has been some life flowing back into our frozen housing market recently. Pending home sales rose a crazy 8.3% month over month. We're now beginning to see certain areas of the country that we're seeing the return of buying frenzies. I just saw an article this morning about the Hamptons, where all the rich people live. That's back in feeding frenzy mode. Home prices there are 2x what they were in 2019, so they've fully doubled in 4 years. But we're gonna have to put that aside. We'll reserve that one hopefully for next week.
I don't know, man, that's such a good one, because just real quick, as a side note, we were just having this conversation this morning, is that, you take a look around, and one of the big trends going on right now in Texas is to buy parcels of land, and you build a 600 square foot tiny home on it and sell it for $250,000.
Mm-hmm.
That's what's going on. So
you're talking to a guy from California. That sounds ridiculously cheap. I know I know the outrage you feel at it, but here we're like,
no, I'm just saying,
to
pay two. I mean, you're talking about a quarter acre of land with a 600 square foot house on it, paying $250,000 or $300,000. Yeah, that's something that doesn't exist in Texas. That never existed in Texas, right? Until the last 10 years. It's just crazy. And it kind of died for a bit, and now it's back. I'm getting all kinds of feeds on this stuff now.
Yeah, and I just put a tweet out, and again, we'll have to move because the real rant I want to have in the little bit of time we have left, which is way too little for it, but is what's going on to the border right now. But I just tweeted out an article about how the age of the median house in America is 40 years old, and almost 40% of the housing stock is older than I am, and I'm 52. Right. And I think one of the things that kind of often gets lost in the whole housing debate is that essentially houses are depreciating wooden boxes. And our housing stock is getting old. And one of the problems is that increasingly, with all the other increases in the cost of owning a home, insurance, we talked about, property taxes have been going up, people getting crunched by cost of living. They're not able to afford the maintenance and the upkeep as much as they did. So, to a certain extent, housing, the depreciation cost is getting larger as time goes on here because people just aren't able to invest in the home anymore. You add that to the fact that over the past, say, 20 years or so, as houses became much more speculative assets and you had these mass developments going up overnight, that the quality of the materials used for the house has gone down, and you can also make an argument that the quality of the craftsmanship has gone down as well. So, here we are, basically saying, no, everybody, you should still be paying today's current, really near all-time high prices for houses at all-time high levels of unaffordability at these high mortgage rates, when a lot of these houses are getting pretty long in the tooth and they're not very well maintained. So again, a rant for a different day, Lance, but you know, I don't know. I look at today's housing market and just continue to scratch my head.
Yes.
All right, so let's just squeeze in as much of a rant as we can right here on what's going on with the border. You and I have talked about this once or twice before, but things are really reaching a boiling point at this point in time. So Lance, I believe the governor in your state, if I got this right, has basically put his foot down hard versus the federal government, and said, look, this is now such a crisis that we states that are have a stake in a secure border. We have to start mobilizing our National Guard and bringing him to get this border more secure. And I think it's something like 25 states have now just agreed to begin to mobilize our National Guards and bring them down to the border. And this is, sort of flying in the face right now of federal policy. And it's really forcing, I think, a big showdown that I'm not sure the administration necessarily wants to have in an election year. But anyways, here we are. So what's the vibe right now in Texas?
Well, I mean, so first of all, if you don't know what's going on, I told you I just went on a hunting trip to this actual place, right? So this hunting lease that I went on actually sits right on the Rio Grande, right next to Laredo Springs and some of these other areas that we're talking about. And so this is right where they cross. And the owner of this property runs like, oh yeah, we find illegals here dead all the time because they come across the border, they drown on the way over, they get drug up and just left on our property. So look, we have 25 legal border crossings across the border for people to cross safely, and they have to go through basically go through the check-in with the border patrol, etc. But to bypass that, they do very dangerous things like swim across the Rio Grande, and so it leads to a lot of deaths. And what Greg Abbott's trying to do is stop that. This one park that they have all the razor wire on right now is one of those very dangerous crossings. And the reason that they do this is the cartels, they basically push all these illegal immigrants to go across these certain areas. They get them all bulked up and they run them across these areas of the border, which detracts all the border guard from where they're supposed to be at their stations down to this area to deal with these crises. Well, when they detract all the border guards down, the cartels run their drugs and human smuggling and everything else across these gaps on the border. So that's why we have this big influx of criminal element into Texas. And now Arizona has now done exactly the same Texas has, and basically has declared an invasion into their state. Now, this is important to understand because this is the battle going on. If you don't understand the battle that's going on, Texas is only trying to secure its border. We're just trying to stem the flow of illegal immigration into Texas because of all the criminal element that's coming across the border into Texas. And it's not just
the criminal element. It's the fact that it's overwhelming all your support systems, right? Your hospitals and
Well, yeah, with that, and you look at New York. Like Greg Abbott started busing these illegals to New York and Chicago and said, "Here, take a few thousand of them. We've got 1 million. Take a few thousand." And now New York and Chicago are like, "We can't handle this. It's overwhelming us." They had to shut down a school and turn it into a housing shelter. This is what we deal with every day here. But importantly, we have no idea these people coming off. These aren't people just from Mexico and South America coming in. These are people coming in from Yemen, Saudi Arabia, others, terrorist countries. They're filtering through the southern border into the U.S.
Afghanistan, Haiti, China. I mean, they're not all terrorist countries, but I mean, they're not just Mexicans and Latin Americans. They're from all over. Yeah,
they're all over. And so what Governor Greg Abbott is trying to fix is like saying, hey, look, we're not trying to stop you from immigrating. That's not what he's doing. He's saying, if you want to immigrate, do it legally. Go through a checkpoint, come in, and just go through the legal process of becoming an immigrant. That's all we're saying. So we know who you are. We want you to be here. That's fine, but we need to know who you are and where you're going. He just he boarded up this park and put the razor wire on it. And of course, this is where the Biden administration is pushing back. They're going, no, we want our border patrol down there to get rid of the razor wire and let these people in. So you see what the problem is.
Yeah. And so can you help me understand? And again, folks, this is a conversation that's difficult to have because there's strong emotions on all sides. And I'm not trying to have this as a good or bad, place a good or bad value judgment on the people that are trying to get into this country. I understand why probably 7+ billion of the world's people would love to live in America if given the chance. And these people are oftentimes leaving, in most cases, leaving, living situations that are, existentially threatening, terrible. They want to raise their kids in a better place. I totally get all that. I'm just trying to see if we can understand the facts here, because it has social but also economic implications, and that's why it's related to this series, which focuses on financial issues. So facts wise, Lance, as best you understand, what is the rationale for the pushback where the federal border control wants to remove the razor wire that's been put down, to help keep people from crossing illegally? We've seen the footage recently of where it's like a bulldozer coming and lifting the razor wire so that these people can get through. Like, what is the rationale for that, whether we agree with it or not?
Because the Biden, this is according to Governor Greg Abbott, right? So the Biden administration wants these illegals to come into it. Even President Biden himself said that, we need these kind of working age men to come in, to the country. We need this. And again, just to be clear, Greg Abbott, everybody else and conservatives in general, nobody is opposed to immigration, right? We need immigration. We've got to have immigration in order to grow our economy. It is the illegal immigration, and more importantly, the undocumented illegal immigration that's coming in to where we don't know who's coming in. And look, I live in Houston, and we have just a tremendous amount of immigration coming in the city of Houston. We have a horrible crime rate in Houston. Now, if you look at city statistics, they'll tell you, like Chicago, Baltimore, New York, Houston, their crime rates are coming down. That's not true at all. It's that we don't prosecute people when they're caught, and we release them. And so we let them out, we bring them in, we charge them, but we don't prosecute them. So it looks like the crime rate is coming down in Houston. It's getting worse, and the crime rate is a real problem. But here's the statement. So the Supreme Court recently ruled, says, hey, we're just putting a stay on this thing. We're going to let the lower court deal with this issue. So the Biden administration can remove the razor wire for right now if they want. Greg Abbott has said, no, you're not. And here's why. This is his statement. The executive branch of the United States has a constitutional duty to enforce federal laws protecting states, including immigration laws on the books right now. And this is the statement. President Biden has instructed his agencies to ignore federal statutes that mandate the detention of illegal immigrants. The failure of the Biden administration to fulfill the duties imposed by Article 4, Section 4, has triggered Article 1, Section 10, Clause 3, that's of the Constitution, which reserves to this state, the state of Texas, the right of self-defense. For those reasons, I have already declared an invasion under Article 1, Section 10, Clause 3 to invoke Texas's constitutional authority to defend and protect itself. That authority is the supreme law of the land and supersedes any federal statutes to the contrary because it's from the Constitution. Arizona just did the same thing yesterday.
All right, super interesting. And look, folks, the intent here is not to make this a partisan discussion. That being said, it is a state versus government, and right now there's,
No, this is hugely fascinating, right? This is what's going on is hugely fascinating from an economic perspective, just a historical perspective, because this is one of those points where you now have a state standing up against the government. This is why there's a lot of talk right now about the Civil War starting here, because this is the South standing up to the North, right? The Democratic South was all pro-slavery. The Republican North, Abraham Lincoln, they were trying to abolish slavery. That was the whole juxta of what led up to the Civil War, right? So so as we take a look at where we are history-wise, this is one of those very interesting moments in time where we're going to look back. This is going to make the history books, because we'll look back at this and go, this was either the brink of, or the start of, or could have been the issue of, a much broader issue. And as more and more states, and again, if you take a look at the states, Florida, Tennessee, Kentucky, other states, other red states are putting their support behind Texas and Governor Greg Abbott. And then you've got 25, 28 states right now all supporting the state of Texas.
Yeah, and that's why I talked about those 25 states. Now, again, words matter. I know it's getting tossed out there. I don't necessarily see this as being like the potential start of the next civil war. And the reason why is I don't see the nation as divided, people on the streets about I'm super pro illegal immigration and open borders versus, yeah, a country should have a border policy and figure out how to enforce it, right? Now, there's definitely loggerheads between federal policy right now and the states that are having to deal with the daily reality of what's going on. And it is clearly, as we've said for a long time now, unsustainable. So I agree, it's getting super interesting. I'm super interested to see how we end up fixing this.
Now, we'll tell you this. I heard a really great interview yesterday between a Border Patrol agent and a commentator. There's basically a commentator. It was on the radio, and he had a Border Patrol agent, and he had one of the guards from the border, and they were like, "Look, the Biden administration wants us to come in, and we've got our orders to come in and basically just process illegals." Now, here's the problem with how we process illegals, by the way, is that what should happen is they come in and they say, okay, I want to come into the country. And then they have to go to a hearing. They have to go through this whole hearing thing. And then they get processed into the country on a legal basis, right?
And meaning we know who they are. We kind of know where they're going to go. Yeah.
Right. So now what they do, but because of this big flood, what they do is they come in and they say, okay, look, you're here. Here's a piece of paper. You just sign it. And we have no idea who these people are. They don't have ID. So they just sign whatever name or they mark it with an X. And it's a promise to appear. And so like in 3 years, they're supposed to appear in front of a judge and never show up again. And so they're in the country. And we give them plane tickets. There is an app for the Border Patrol that they can use to actually use as a form of identification. They can get on an airplane and fly. We have to go through the TSA pat down. We got to show our IDs. We got to do all this stuff to get on an airplane. They don't have to. They just show this Border Patrol, app that has their name on it, says they're here illegally, and they can get on a plane and fly to wherever they want to go. So that's kind of scary. But what this is going to lead to, and they were talking between the border guard and the patrol. They're saying, look, we want to work together. There's not this big conflict, between the federal government, like they're all just going to come down in armed forces and do this. They're like, look, we know the Border Patrol has to do their job. We're trying to do our job and secure the border. We're going to figure out how to work together. So this will be, something that works itself out. What'll be interesting from the political front is how this heats up, in the media as this goes on.
Absolutely. And I don't know if it was in the New Hampshire primary, but in the Iowa primary, it was the #1 issue that folks said they were voting on. So it's going to be interesting to see if that continues throughout the year, or, my prediction is, I mean, if it gets worse, it probably will stay there. But my prediction is that some of these basic, economic, like I'm just having trouble affording my way of life, issues might supplant it. But it's definitely right up there at the top right now. It's something Americans really care about.
Well, look, I mean, we just saw the employment numbers here recently. The number of foreign-born workers that are in the United States is, you're talking earlier about, people trying to get a job. And I've talked to a lot of people. They've sent out like 1,400 resumes, right? They can't get a job. And, when you get down to the lower wage paying scale, these illegal immigrants, they are getting jobs here, right? They're taking jobs from native born workers. And when you have 3 million plus in the system, that makes a dent. And particularly when we're talking about restaurant worker jobs and waiters, waitresses, those type of things, kind of lower end, kind of that lower end scale of the jobs, we can hire cheap labor doing that. Right. And so it has a consequence economically that is not necessarily that great for the average American.
Yeah. And so that's kind of where I come to all this. And yes, there's the humanitarian side, and that should be paramount. But I'm always, with any issue, saying, okay, well, what are the economics? And I just think, how do we afford the influx of this many more people onto our social support systems in our economy, right? And you just talked about one of the issues where, you know, this may be, you know, maybe biting U.S. born workers, U.S. citizens on the lower end of the pay scale. But also I mentioned, you know, this is happening all over, but there was a stat, I think it was a hospital in Denver or something like that, that they, over some period, I don't know if it was a weekend or a week or a month or whatever, but it was something like this, said our emergency room system in the state saw 50,000 people, which was a huge spike from what the normal period was. And they said 20,000 of them were illegal immigrants, basically. And they're just saying, like, we're getting overwhelmed by the volume of people that are coming in and drawing on these services. And of course, these people don't have any money to pay, right? But the hospital's not going to turn them away, right? So, you know,
which that right there is such a critical point, because, you know, the average American complains about healthcare costs. And, you know, this was always one of the fallacies behind the Obama Affordable Care Act, is that, oh, there's 20 million people in the US without insurance and they can't get access to healthcare. That was a bold-faced lie, because you go to the hospital, you get taken care of, period, right? But somebody's going to pay for it. And so when you have all these illegals coming in the system getting free healthcare, somebody's going to have to pay for it, and that's you. So, I mean, it's, and look, and again, I'm not against immigration at all. Don't think that for a moment. I am very pro-immigration. We must have immigration in order to grow our economy, because we're not having enough kids.
Yeah, especially because their birth rates are dropping so fast.
Right.
Yeah.
So, you know, what we're talking about, and very specifically what we're talking about, is an overwhelming amount of illegal immigration that's potentially letting very dangerous people into our country. And again, you know, at some point, we let a terrorist in, he blows up something in a major city, and then everybody's going to be very, you know, anti-illegal immigration. Unfortunately, it'll take that type of thing, and then everybody will understand what the danger of illegal immigration is. But that's the risk. That's what Greg Abbott has been telling people. It's like, look, there are people coming in this country that are very dangerous, and we need to be aware of that.
Right, and even short of that, and you know, let's all hope that that doesn't happen. But obviously, the risk of it goes up with the more of these people that flood across, who we don't know who they are. But just all you have to do is look at the fentanyl problem that's going on right now, right? I mean, it's just when you have a border where this many people can get through, because of course we only know the people that we monitor and see, right? So what's the size that are making it through that we just don't know, right?
The stat, the believed stat at the moment is that we catch about 30% of what crosses.
Yeah, which is, if you look at the numbers that we are able to report on, and if you double that, more than double that, it's mind-blowing. And then of course the issue that I always have too is, like, we have a human capital problem in this country, irrespective of illegal immigration, right? Where we've got, what's the stat? It's over 100 million US adults age 18 and over who are considered out of the workforce, permanently out of the workforce. The government has ever given up on them getting a job again. Now some of them are seniors who are too old to work, some are in college, but there's a big and growing chunk of just unemployed, underemployed Americans that are sitting on a couch playing video games, you know, not feeling super optimistic about their lives. We need to be using the existing human capital here better before we bring in floods of other people that we don't know what to do with, right?
Well, and then, but you also talk about, you know, when, you know, like I told you, when I was down hunting on the border, you know, I was talking to the owners of the property, and like, oh yeah, well, you know, we see them when they come across the border, and the border guard, you know, gives them $5,000, you know, gives them a ticket to wherever they need to go, or wherever they're going to send them. But, you know, so there, you know, there's money that's being given to these people.
So say that again. Are we really, like, giving the average processed guy $5,000?
Yeah. And this is according to them. Now, look, I was just on the border, and it's like, yeah, we see them all the time. They come over, they hand them basically a debit card with $5,000 on it, and they give them a ticket, and they put them on a bus and send them somewhere. But yeah, I mean, there's money. I mean, this isn't just because they come across the border, they're tapping into our social welfare system. So we're having, you know, taxpayers, all taxpayers are having to pay for this. So you may be pro illegal immigration, and again, that's a you thing. If you think everybody should be allowed to come here, that's awesome. Just realize you're paying for it. You're paying for it in higher healthcare costs. You're paying for it with your tax dollars, and that's all fine and dandy. And if you're good with it, I got no problem with you. That's a you thing. All I'm telling you is that, you know, there's a cost to this. that, if you're struggling to make ends meet, maybe we should be focusing our efforts on taking care of our citizens first, and then all this other stuff maybe second.
Right. And part of the cost too is the human cost of all the people who have the promise of, oh, I'm going to get into America, right? And they're coming from somewhere deep in South America or some other far-flung country. And it's a treacherous journey, right?
Yeah.
So what we don't see is all the people who die along the way because it's a risky, perilous journey. All right, we got to end it there. I wanted to put this brightly on our radar, folks, here, just because it is happening now. It is very germane to what's going on today, but it does impact the economy, and it is highly likely, I think, for better or worse, to become even more of a focus point, even more of a flashpoint going forward. So I don't want to be late to the discussion, if indeed there are big developments here that we want to talk about in the future. All right. Well, in wrapping things up here, folks, I just want to give some happy news about goings on here at Thoughtful Money. Thoughtfulmoney.com, the website, is now live, as I mentioned. So for all the discussion that Lance and I have had up to this point in time, it is a tricky time for people to navigate what's going on if you're a regular investor. There's some great services out there like simplevisor.com, if you want to look over the shoulder of a good financial advisor like Lance. But for a lot of people, they don't want to look over the shoulder. They actually want the good financial advisor to manage their money for them, to be their financial quarterback. That's the main reason why I have Lance and the guys from New Harbor on this channel every week, is I want you to see what a good financial advisor looks like, one that takes into account all the macro issues that the interview guests and I discuss on this channel week after week after week. And I want to have you see how they react to changes in the market and how they're allocating their capital. Lance does a great job of being fully transparent on that. So if you are just a regular investor and you would like to get a little bit of direction from a professional financial advisor like Lance or the guys at New Harbor, we've got a firm up in Canada as well, then go fill out the short form at thoughtfulmoney.com and have a free consultation with these guys. There's no commitment to work with them. There are no strings attached. It's just a public service that these firms offer to help regular people who are busy with their lives, running their families, trying to figure out their own work lives, and being able to help them by becoming their financial quarterbacks and managing the financial parts of their lives so that regular people can go off and do all the things that they need to focus on. And let's see what else. As I mentioned earlier, too, the conference that's coming up for Thoughtful Money, as I told you folks in the past, hopefully you've marked your calendars. That's going to be Saturday, March 16th. But we've now got a place where you can go to sign up to register for the conference. Just go to thoughtfulmoney.com/conference. You'll get the early bird discount price of $249. That's a pretty substantial savings. I think it's something like 30% off of the full ticket price. If you are a premium subscriber to my Substack, you'll get an additional $50 off that price. And I'll be sending an email out to all the premium Substack subscribers. So folks, make sure you go get that discount code if you're going to register. And look, if you want to game the system, just become a subscriber to my Substack for a month. It costs $15. You pay $15 to save $50. What's not to like in that scenario, right, Lance?
Yeah, exactly.
But I just want to let folks know that we've got a really good faculty lineup already scheduled for this. So Lacey Hunt will kick it off with his usual tremendous keynote. We'll have Michael Pinto there, Stephanie Pomboy, Ted Oakley, Tom McClelland, Daniel DiMartino Booth, Brent Johnson, Matt Peipenberg. Even your partner, Mike Leibowitz, just signed on this morning, Lance, to talk about bonds. So really is a pretty phenomenal lineup there of folks. A lot more details on this to come, folks. But if you want to learn more about the conference and register for it to lock in the low early bird price, again, just go to thoughtfulmoney.com/conference. And folks, if you enjoy these weekly market recaps with Lance and I, no matter how rocky the controversial waters we're willing to wade into, like illegal immigration, please show your support for our courage or our craziness by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, as usual, I'm going to give you the last word.
Hey, no, appreciate it very much. And, you know, we're having a good day already right here in our conference. So I wish y'all were here. I'm sure we'll do it again next year. So maybe we'll see you next year.
All right, great. And you know, next week, Lance, we can hopefully give the highlights for folks here. Maybe we'll kick off this video with the highlights from the conference. All right, Lance, thanks so much again, buddy. Looking forward to seeing you in Houston in just a couple of hours. Everybody else, thanks so much for watching.